The Fed cut, what it really means, and what happens next. Good evening. The Federal Reserve has cut interest rates by a quarter point, setting the policy range at 4% to 4.25%. Officials called it risk management. Inflation is easing unevenly while the job market cools. One governor dissented, favoring a bigger move. Tonight we unpack what changed, what it means for your wallet, and how to plan for the next two meetings, the anchor reported informatively. Segment 1. What exactly happened? The policy rate changed from 0.25% to 4.25%. The tone was data-dependent, with no preset path. There was one dissenting vote for 0.50%. Implementation included trimming admin rates, like interest on reserves, to transmit the cut. To translate, the Fed is nudging, not diving. It wants to cushion employment while keeping pressure on lingering price pockets. Think course correction, not rescue mission. Segment 2. Why now? Hiring has slowed from last year's pace. Unemployment ticked up, wage growth cooled, and some cyclical industries show fatigue, the anchor explained analytically. Headline inflation eased, but services remain sticky. The Fed fears waiting too long could let unemployment rise faster than desired. Cutting too fast risks reigniting prices, hence a measured step. The labor economist said professionally that risk management means you move early and small. If the data softens more, you can cut again. If it firms up, you pause. Segment 3. Markets. Why the shrug? Stocks wobbled, then stabilized. Yields dipped, then bounced. Investors are handicapping two paths, a gentle easing cycle that supports earnings versus a slowdown that hurts them. The message from traders: show us the glide path, the anchor said analytically. If long yields fall in line with cuts, multiples hold. If they don't because growth looks wobbly, equities get choppy, the portfolio manager explained, drawing on experience. Segment 4. What this means for you. Mortgages are not directly tied to the Fed, but if bond yields trend lower on expectations of more cuts, mortgage rates can drift down. Timing varies. Auto and personal loans, as well as credit cards, are often linked to prime. You can expect incremental relief if this becomes a series of cuts. Small business credit, particularly variable rate lines, should ease a bit. For thin-margin businesses, that can fund a hire or a van. Savers with high-yield accounts may see rates tick down in the coming months. Shop around to find the best rates. A mortgage broker warned, don't chase headlines. Watch Treasury yields and fees. A slightly lower rate can be erased by closing costs. A bakery owner explained practically, 20 basis points on my credit.